looking at the other screen to see when we go live. And there we go. We're good to go. So, welcome back, guys, to part 7, I'm pretty sure, of the Back to Basics series, where, again, we take some people who work with trade ideas, who are interested in learning about trading, and we're kind of going from beginning to machine learning, AI, back-tested, auto-trading strategies, and these guys are going to become our next hedge fund managers, is the hope. So again, I've turned on the chat. You should see that below the video. If you have any questions throughout, just type them in, and I'll take a look at that kind of as we go, and we'll have a little area for Q&A at the end. So we'll go back into basically where we are last week. So far in the charting series, we've talked about candlestick patterns, support and resistance, now trends, which is not what we talked about last week, but I had a little brain fart here. We talked about technical patterns last week, where we went to talked about bull flags, bear flags, head and shoulders, double tops, double bottoms, the very kind of typical patterns that you'd see in almost any technical analysis type of workbook or whatever. So I'll ask, just like every week, does anyone have any questions or any discussion topics for kind of the homework you had last week, where I gave you guys just a bit of a way to look for my favorite pattern, which is the bull and the bear flag?
I have a question.
Okay, Marissa.
Well, I'm a little confused on when to know where you see a flag pattern, because I feel like you can almost draw a flag anywhere. So I was wondering if we can go over how to define or find a flag pattern.
And yeah, this actually comes down to a larger topic throughout all of technical analysis, which, you know, I think you guys are seeing a lot of. There's a fair amount of subjectivity, one could say, to this game, to technical analysis. See if I can find something that works here. The simple answer is you'll never know, right? If it's something that could have been that easily seen and spotted, it would be programmatized and then kind of pushed out of the market. So then the question becomes, so how do you know, right? How do you know what's a flag and what's just some, random market chop? And the answer is going to be kind of the setup to it, right? So one of my trading mentors always
Piggyback real quick off that.
Yep.
My other question to that is, can you have multiple patterns in one? Like the head and shoulders could also be a flag on the shoulder. I don't know. Maybe I'm looking into it too much. I don't.
No, that's actually a really good observation. So let me just take my drawing tool here. So, an inverse head and shoulders would kind of look something like this, right? That's what we talked about. Whereas if you look at kind of this half of it here, it's a bear flag, right? You had the down move, a bounce higher, and then a move lower. And then over here, you have a bit of a bull flag, right? So the main thing to keep in mind is that the point of these patterns are just to kind of demonstrate that prices don't move straight up or straight down. They move in kind of these waves that you can see. So what we're trying to do with these patterns is not really strictly define something that, again, could be programmatized. It's to give your kind of brain something to compare things to. So we talked about how I'm big on analogies, and I'm sure people have noticed by now I talk a lot when it comes to teaching and everything in analogies, and kind of think of technical patterns as kind of the same way as an analogy. Essentially, all a bull flag is the price moves up, and then it takes a little break, and then moves higher, right? And you're just trying to take advantage of this little break so you know where to enter and where to exit on this next move higher. But yeah, there's patterns and patterns. There's patterns for everything. You can go way deep down a rabbit hole, which is actually something we're going to discuss a bit too today. But to focus on what is, quote unquote, the best pattern is going to be a lot to do with the trading psychology of the market in total. So this SJM, so Schmucker, essentially why is this stock interesting? And this stock is interesting because it's actually moving more than other random stocks. So essentially, there's only so much money to go around. There's only so much attention to go around. So if you pick a stock that absolutely no one cares about, there's not going to be this kind of momentum to carry your moves. So what I would do is I would focus, when you're trying to build these patterns, is focus on stocks that are actually, we call it in play. So things that people are talking about, stocks that are moving. For example, this one went from, say $100 to 115 in, what's that, 2 weeks, right? So that's a 15% move. So anybody who's in this stock made 15% on their money in a matter of weeks. And in traditional finance, most people would be very happy to have 15% on their money in a year, right? And then it chopped sideways for a bit and then moved higher. Whereas if I just try to find another example of something that's significantly less interesting, stocks that don't move would be something like this, right? Where this stock is essentially right where it was this time last year. So the hard answer is there's no exact answer. It's going to come from you looking and watching and observing what works and what doesn't. That's why trading is as long of a journey as it is. The answer to try to push you in the right direction is try to pay attention to what people care about. So either what people are talking about in the news, Lyft was IPO'd recently and it's been big in the news. Same with Pinterest. Some of these, Facebook and Twitter are being talked about a lot. Apple's always being talked about. But also look at the price action, right? So one thing that Trade Ideas does well is it allows you to scan for whatever price action you want. So this scan, which is what I'm going to give you guys down the road today, is going to be looking for things that have at least moved higher or lower pretty significantly in the last week or 2 days. So kind of use the fact that people are either making a bunch of money or losing a bunch of money as kind of a cue, as that's what I'm going to watch. And those are the only things that I'm going to try to draw these patterns in. And I'm going to ignore anything that's just kind of moving sideways. That help at all? I know it's not a great answer, but unfortunately there really is none. Because if there was a way to say, here's how you absolutely perfectly define it, and here's where the entry is, and here's where the stop is, then some guys from MIT would have just built that into a program, and then that act of trading that would destroy that pattern. And that's why what we do as Trade Ideas is we try to merge the machine and the man together, because there's kind of a place for both, right? Where men are good at, women, humans are good at subjectivity. They're good at understanding things, whereas a computer is going to do what it's going to do based off a certain set of parameters, right? So we can use the machine like this that will help find these types of patterns, and then it's up to you. And again, the hard answer is you just got to do your homework and start watching. Steve always calls it the 10,000 hours of sitting in front of the screen is how these things generally get decided. So that was good. I like questions. Did I open the wrong one? Oh, no. Okay. So we went, and this was just going through last week. We essentially talked about, this type of rising wedge, falling wedge, flag pattern, whatever you'd like to call it. And today we're going to talk about indicators. So first of all, before I get a lot of angry comments and tweets and everything, one thing, you guys who aren't trader, indicators are a very polarizing topic in the community, whereas some people think that it's the secret to making money and other people think they're completely and utterly worthless. I'm more on they're worthless-ish tab. But I think it's something that I should teach you guys about anyway. Essentially, an indicator is something that uses price and applies math to that price to then try to come up with signals and systems, a way to programatize the market, just following these indicators. And it's good because it can help traders identify trend, which we've talked about easy. It can help traders identify direction. It can help them identify overbought or oversold when something's getting a little bit too crazy. The downside to them is that there's none that have been proven scientifically to work continuously. Therefore, they can cause a lot of problems within trading. But what I'll say to all the people who are about to yell at me for that is if it's working for you, keep doing it. And we're going to talk about it here, but I'll show you in the final slide why I'm not really a big fan of these. So here's just kind of the Investopedia write-up about what indicators are. Again, they're essentially just using historical data the way we do in technical analysis and pushing this forward and trying to come up with some sort of a line on a chart or a visual indicator to help you decide when to do what. So the easiest one, and the ones we have on our charts here at Trade Ideas, we have a lot of these, but not all of them, because kind of as a firm we agree that there's not an insane amount of value to them. But a moving average is simply taking the closing price of whatever candle you're looking at, so a 15-minute candle or a daily or a weekly, whatever it is you're looking at, and averaging out those prices. So what people will use this kind of thing for is establishing a trend of a stock, the same way we talked about drawing a line to establish a trend. It smooths inconsistencies of data, right? So if you think about it as housing prices, and the average housing price in your area, every year gets a little bit higher, and then one year there's a fire or something that drastically lowers prices, but then they're right back where they were the next year. You really wouldn't want to look at that in more of a line chart. You would want to smooth out those averages, right? And this is what this does, where this blue line is a 20-period moving average of these candles. So essentially what it's saying is I'm going to take the last 20 closes and I'm going to average them out, and this is what this price is going to be. So again, it helps smooth where price is really doing this. If you're a long-term investor or a long-term trader, you may only care that on average price is moving up like this, right? So it's a way to very quickly and simply, and this is why you'll actually notice me being anti-indicator, I have something like this on my chart, because it just helps the eye see, okay, for the last X period of time, we're moving higher. But the reason I chose this chart in particularly is because you can see we had this massive spike down that erased all this movement, and only then after that did the moving average turn lower. So the important thing to note is that all of these indicators, everything we're going to talk about, is derived based off price action. And when you derive anything in math based off anything else in math, it's then going to be slower and it's going to be laggier than it, right? Because it needs that new data input to get put into the math equation to then go through the next day. So it's always going to be a few days, in this case 20 days behind. So don't worry, you don't need to know this, but this is essentially the math behind it. So this is what a lot of traders try to do, where they try to really fine-tune and hyper-program these things, where essentially this is an exponential moving average and a simple moving average, and basically an exponential moving average weights the most current stock price more than the ones in the past, where a simple moving average is just a simple thing. And for you guys who help out and support, you've probably seen a lot of discussion with people, a lot of people asking for EMAs or exponential moving averages and this type of thing. And it's not something that we scan for, because again, with Trade Ideas, we believe that the price action controls everything because it's what happens first. So that's your moving average, and that's the biggest part of it. And to be honest, that's the only one that I believe has any value. Again, especially for you new guys, when we start building out your charts, we're going to put these moving averages on your screen, where it's going to give you a way to make sure that we don't fight the trend. We spent a lot of time talking about trend and how you should be trading in the direction of it to make your life easier, so you can start to develop simple rules. Like, we're going to build a trading plan for each of you based off the homework that you guys are doing. So part of that might be a checklist, right? So as a trader, we generally build a checklist before we enter every trade. We'll say, okay, what's the stock doing? What's the news? What's my scans telling me? What are the market doing? And one of those things may be, is the moving average pointing up or down, right? Is it with me, showing me that this trend is in this direction? And that, I believe, has some value. Now, oscillators and these type of things, again, I want you to know about them, but then understand why I don't use them. If you want to use them yourself, go ahead. Essentially, what these type of oscillators, RSIs, do is they essentially look for dramatic price movement. They rank the stock based off of how quickly it's moving and assigns to it either an overbought or an oversold state. So this is a situation where things kind of worked, whereas in this area, this RSI indicator is telling us this is oversold, basically saying based off the math, this has moved down way too far, way too fast, and there's a potential buying opportunity here. And then it also said right here that this is overbought. So it's moved too far, too fast, based off of what it normally does, and it's going to sell off. So that looks great, right? You buy when it's down here, and then you sell when it's up here, and you get rich and go home. The issue is, if you fine tune this, it also said you were oversold right here, right? So you would have lost this amount of money before a rebound. It also said you were overbought right here, right? So the stock would have continued to move higher. I don't know what this happened, but it also said it was oversold here. So what's the value of even knowing about these things if I don't really agree with them too much? Well, in Trade Ideas, what we can do is we can filter out stocks. That's the main thing that Trade Ideas does, is it kind of filters out stocks that you don't want to see. So for example, if you know that there's somewhat of a probability that when an indicator like this is oversold, that it has a pretty strong potential of bouncing, you just might not want to short that, right? So where a lot of people will use these indicators as a way to trade, what I like to do with them, and what we do a lot at Trade Ideas, is we use them to know what to avoid, right? Not necessarily, I don't want to buy this stock, but because this indicator is pointing oversold, I might not want to sell this stock. It might be getting to the point where this bounce is coming, and if I wanted to sell this stock, maybe I wait until we're at a more of a neutral strategy. Because as I talked about with a lot of the patterns and the trend and pretty much everything to do with the market, is it's a giant self-fulfilling prophecy, where if enough people watch this and they believe that when this stock is oversold, it's going to bounce, that in and of itself is going to create buying pressure. So you just might want to sidestep that buying pressure. And again, in Trade Ideas, it's very simple to say, well, just don't show me stocks that they're down here if I'm looking to sell. And if I'm looking to buy, just don't show me stocks that are up here if I'm looking to buy. So the next one here is a MACD, and this is the one that makes the least amount of sense to me. And again, I know I'm looking over at the chat here, and I'm probably angering someone already, but essentially what this believes is that if you have two moving averages, you have one that's, maybe the last 10 candles and one that's the last 20 candles, is as these moving averages cross, there may be symbols to be had there. But again, this is more of a cautionary lesson than anything else of what you guys, if you're out studying on your own, what not to avoid. Is there's a lot of people that will point to these things and say, look, here's my indicator, and when it said sell here, look at what happened to the stock, it sold off. And then they ignore the fact that it also said sell right here, right? And that, it also said buy right here. So these are, again, they're ways to help you and the ways to guide you. But the reason I talked about things like trend and market psychology first is because although if you do decide to use these, that's entirely up to you, but they should be used in conjunction with these other things that we talked about. Maybe you see an indicator and that lines up with a trend that also lines up with a technical pattern, and then you may have a trade associated with it. Is this making sense to everyone else? I'm scared to look over at the chat over there just in case you'll see if you read comments on this video and everything, there'll be a lot of people that are upset with this. Last but not least is a Bollinger Band, and this is a combination of a moving average and an oscillator. So there's people just combining these maths on top of each other. This is the main reason that I wanted to show you guys why I don't use indicators. This is an actual chart that somebody actually uses to trade. And the problem is, if you're squinting to try to figure out what's going on, so would the trader, right? There's all types of different indicators and oscillators and moving averages here, but what they end up doing is they end up clouding what actually matters, which is what is the price doing, right? We talked about how technical analysis is essentially trying to figure out crowd psychology, right? And if you're ending up doing all this, then what you're doing is you're kind of ignoring the crowd psychology. You're seeing the trees instead of the forest, right? It's like if you were to be looking down while you're driving and you're paying very close attention to all your instruments, right? What's my speed? What gear am I in? You know, all of this, and you're not looking at the road, right? You're not seeing where the buyers and the sellers exist because you're just focusing kind of on this math below. So that's essentially the lesson part. So what I wanted to show you guys is, again, my personal setup. So what I use indicators for, because again, I spend a lot of time bad-mouthing them, but there are some that I use. And this is what you'll see is pretty common as well. Here, I can make this bigger for you guys. There. Zoom in. So this yellow line is essentially a moving average. So it's an 8-period moving average. I don't think there's anything magic with that math, but the point is it's a short-term moving average. So the reason that I use this type of indicator is because I can quickly look at this chart and I can see what the trend is even without really evaluating the candlesticks themselves, right? I know that if this line is pushing up, and it has been for a while, that this is in a nice strong uptrend. So in my personal trading checklist, it would go, okay, I am with this moving average, which means at least the last eight periods, or you know, about the last 2 weeks, we've been moving higher. There's been higher prices throughout. So that would interest me more as kind of on the long side of things. And vice versa, if this thing is moving down, I know at least the last 8 periods, the trend has been down, and I want to trade with that. And then when I talked about before how I use these to stay out of the market, I have a simple rule in my trading plan that says if it's moving sideways, don't take a trade, because it means for the last 8 periods of time, nothing really has changed in the market. So don't take a trade right now. Wait until something occurs that is actually pushing the trend where it may or may not go. And then again, with this one, you could see how you could combine a couple of these things that we were talking about into a trading plan. And this is what the point of this I really want you guys to pay attention to is that, so this, right, a big strong push up and then a move sideways, or you could even call this the whole move sideways, right? So that's a bull flag that we talked about earlier. At the same time, we know that the trend is higher, right? Every time sellers come in, they're met at a higher price here. So the bulls are in control of the stock. And at the same time, my very simple moving average is pushing higher, and it's not that far away. So it hasn't really run too far to exhaust itself. So this is more or less how a trader will think, where they have a checklist where this stock in particular interests me. You know, I actually have in my robot tomorrow that if we break the high of this price to buy in and put a stop down here and see if I can get a little run to 35. But the way I built that was, again, to go first with the trend. What's the trend of this stock? Okay, it's higher. Second, what is the pattern of this stock? Well, we pushed higher and now we're chopping sideways. So that's my my flag. And then thirdly, what is this really basic indicator telling me? Well, it's just confirming that at least the short-term trend is along with it, because here we're going back into last year. So this is a very long-term move, but I'm a shorter-term trader. I buy things for 1 day to 2 weeks is kind of my time horizon. So I want to know what this last 8 days have done, and I can see that easily with this moving average. And then on top of that, you see all these bottoming tails, and we've talked about this a lot when we did the candlestick analysis, showing that bottoming tails are essentially saying that intraday, these 4 or 5 days here, every time it's sold off during the day, a buyer came in late in the day and pushed it higher. So you start to see how all of these things really on their own don't mean a hell of a lot. But what you're trying to do is you're trying to push all of these things together so that you come up with a plan that is systematic. It's something that's repeatable, right? What traders will always talk about is the next trade doesn't matter and the last trade doesn't matter. What matters is the next 1,000 trades. You know, if you continue to do this thing, you need to be able to make sure that you're doing roughly the same thing for the next 1,000 trades, because everything is in trading is probabilistic in nature. You know, I always say flip a coin 3 times and tell me what the win rate or what the heads tails rate is a coin. You can't, it's impossible. It's mathematically impossible. So again, what we're trying to do with all of these things, and this kind of goes back to Marissa's first question, is we're not trying to really hard define anything. We're trying to build our own plan. This is how I think about the markets, but it may not be how you guys think about the markets at all. You might look at this and you might put one of those oscillators on it and say, yeah, but it's way overdone, so I'm actually going to short it here. And you might be right. But the point is, I have a plan that I know how to take and when to take all of my trades, so that hopefully over the next 1,000 trades, I'm up, essentially. And then most of that goes into things like risk management, which we'll talk about probably in the next few videos, which will be the most boring lessons, 100%, but will without a doubt be the most important lessons. You know, you can be right 30% of the time and make a lot of money in this game. And you can be right 90% of the time and lose all your money in this game, right? It's all about how you manage that risk. So that's indicators, very basically. Any questions? Anything? No? That made sense? Did I scare you guys away from them enough? And again, I know I'm going to get some hate when I look over there, so I'm going to leave this up because this is the reason why I don't like them too much. There's simplicity, I think, is key. So Gregory asked if you can have a copy of my screen. I can share it to you. Unfortunately, most of it won't work. I have a lot of custom indicators, so when you load them up, you'll be looking at different stocks. Marissa, do you have a question?
If you go back another slide, I think it was, nope, the next one. Yeah, I don't know. You did kind of lose me here when you were saying when you were looking at a candle and you should have bought here and you should have bought there. And it looked like you were also comparing it to the one underneath. And so I don't.
Yeah. So no,
either.
That's fine. So what the MACD is essentially looking at the distance between two moving averages. So the moving averages we talked about way at the beginning, how I talked about how you can do a 10-day if you want to know what the average of the last 10 days was, or a 20-day or a 50-day. What this does is it takes 2 different time frames and it compares the distances between the two. So these moving averages could very easily be on the chart up here. And the theory behind the MACD is when these averages cross, if the blue line would cross over the yellow line higher, that would be a buy signal. And if the blue line crossed under the yellow line lower, that would be a sell signal. Right? So this is why, you know, I noticed that, again, I stole this from the internet. Whoever grabbed this basically said, here, look, it's bearish confirmation and you should have shorted here, and this was a great trade. But what they don't pay attention to is all the times that it didn't work as well. which again isn't hugely important, because if you are managing your risk, then maybe there is a strategy here. But it's mainly focused on this crossing, which I really don't think, again, my personal opinion, there's not a lot of value.
That's where I was confused at like what you were drawing the line from earlier. Now I understand.
Yeah, and I don't want to spend too much time on how all these work, because there's literally thousands of them. There's thousands and thousands and thousands of indicators, and my theory has always been, if I built an indicator that really worked, that without any human interaction at all just made me money, I'm not telling anyone. I'm not publishing it anywhere. You guys would never know. I just wouldn't show up in Slack one day, essentially, is how it would work, right? So again, there's tons of them as well. I think the rest of them is just talks about indicators. Some like them, some hate them, some think there's some value in some of them and not in others. There's a question about Fibonacci's, and that's actually a really good idea. We will do a brief, thank you for that. I was wondering what to do next week, but we'll actually do a little Fib and Elliott wave kind of summary next week. I wonder if we have an Elliott wave expert. Interesting. But yeah, so there doesn't seem to be, again, all questions from you guys or questions from them for the next minute or two. I know some of you guys have things to do. I don't. I'm just going to go back to looking at charts after this, but okay, so if there are no more questions, again, there's you guys can leave comments on these videos. I actually go through the comments on our videos and try to answer questions there, so you can do that as well. And just for if you want to email something in and tell us how awesome we are, info@trade-ideas.com. I'm Bonpara on both Twitter and YouTube. We should really get you guys in here as well. And yeah, so I think that's all for today, and trade safe out there, guys.